Hello students, welcome to all of you Shiksha 360. And today basically we have to discuss the chapter number 12 of accounting. That is basically chapter number 12. It is basically of the module B. Clear? Chapter number 12 basically it is of the module B. And we have to discuss that. Clear? So today in this session basically we have to discuss most of the theoretical portion. Clear? As it is basically as they have provided in the syllabus. Clear? We have to discuss line by line all the important points regarding that. So let's start our discussion on the basis of that. So chapter number 12, part 1, clear, and chapter number 12, it is related to the bills of exchange. So I have directly taken the material basically from the book as they have mentioned one by one, clear. So let's start our discussion. So can anyone tell basically what is the meaning of the bill of exchange? Clear, basically what is the meaning of the bill of exchange? Clear. So there are two words. One is the bill of exchange and second one it is known as the P notes. P notes basically it is sometimes basically it is also considered as the promissory notes. Okay. So we have to discuss regarding that also. Let's start our discussion. So the main journal, clear. So the main journal basically it is divided into a number of journals, clear. The main journal basically it is divided into a number of journals. So this list includes bills receivable journal and bills payable journal, clear. So basically there are two journals, that is bills receivable journal and bills payable journal, and we have to discuss on the basis of that, clear. So when the transactions of a similar nature are many, a separate journal basically will be maintained. Like basically we can say that basically there is a landlord has 25 shops and all the 25 shops basically they have given on rent, clear. So basically every month the person this person will receive the rent, clear, basically will receive the rent from all these 25 shops, clear. So that is basically here they are saying the same thing, that is basically when the transactions of a similar nature are many, clear, there are basically 25 transactions. So a separate journal basically will be maintained for that specific thing, clear. Separate journal basically will be maintained for that specific thing, clear. So now let's discuss. So now let us first learn the basic entries for bill transactions, and then basically we will learn to record these transactions basically in the separate journals, clear. That is basically in the bills receivable and the bills payable journal, clear. So we have to discuss regarding that also in this session, basically what is the meaning of bills receivable, what is the meaning of bills payable, and what is like what I'm saying that basically what is bill of exchange and what is promissory notes, clear. In the examination basically you will get basically one question basically from the bill of exchange and promissory notes, and mostly basically I have seen that basically theoretical question basically they will also ask it from that, clear. Theoretical question basically they will also ask it from that, like some what is drawer, what is drawee, what is pay, clear, in the bill of exchange or in the promissory note, clear. All these types of things basically they will ask in the examination. So basically we have to take it regarding all these things, clear. So let's start our discussion on the basis of that. So type of instrument of credit, clear. First of all, basically we have to discuss basically types of instrument of credit. Like basically you can see that basically there is CC limit is going on in your branches. So basically what is the meaning of that, clear, basically why they are, like basically if any manufacturer purchases a raw material, clear, purchases a raw material basically from the any third person, clear. So they will not do the payment, clear. They will not do the payment basically at the start, clear. So they will take the raw material from that on credit, clear, on credit, that is payment will be given after some time, clear. They will take the raw material basically on credit, and after that, clear, basically, and after that basically the manufacturer basically will manufacture the products, and basically we can say that basically sales further to the clear raw material. Further it comes into the factory or manufacturer, they process, it becomes product, sell, wholesaler, retailer, purchase on credit, sell. Okay. So that is purchase on credit. That is basically they have not given the complete payment to the supplier. Clear? Basically they have not given complete payment to the supplier and taken the raw material from that and process the raw material and further sell the goods. Clear? And further sell the goods basically to the wholesaler and the retailer. Clear? And further sell the goods basically to the wholesaler and the retailer. So here what they are doing, clear? So here basically what they are doing, that is basically one person is selling the material on the credit. Similarly, further this process is going on was step by step. Clear? They are selling the goods, clear, basically to the wholesaler and retailer. Clear? And not all the goods, clear, basically, and not all the goods to be sold on the credit. Basically, some goods are to be sold on the credit, and some are basically they will get the payment on the spot. Clear? They will get the payment on the spot. Clear? So these are the main things regarding that. So types of instrument of credit. Clear? So types of instrument of credit. Clear? So in a business basically credit transactions play a very important role. Clear? Basically credit transactions basically play very important role. Clear? So here basically they will sell the material on the credit. So basically what proof basically they will have in their hands, so that basically later they will claim the money if they will not pay the money. Clear? If they will not pay the money, so what technique basically they will use. Clear? So let's discuss. So in a business, basically credit transaction basically play a very important role. So for manufacturing goods, a manufacturer basically purchases raw materials, the majority of which will be on the credit. Clear? The majority on basically which will be on the credit. Once the goods are manufactured, clear? Basically once the goods are manufactured, these will be sold to the wholesalers and retailers. Clear? Basically once the goods are to be manufactured, further basically those goods, clear? Basically those goods basically will be sold to the wholesalers and retailers. Clear? Here also the manufacturer basically will give credit to his wholesalers or regular customers. So thus credit passes on from the manufacturer basically to the wholesaler, and from the wholesaler to the retailers, and from the retailers to the ultimate customers. Clear? And from the retailers to the ultimate customers. Clear? You will see that basically at some places you will find that basically on the shops, clear, there is an account going regarding particular customer. Clear? That is basically we will give the payment on the 10th of every month. Clear? Basically after getting the salary, or we will give the payment after 7th of every month. Clear? So even basically shopkeeper has open accounts, clear, basically for their customers. Clear? That basically they will get. Clear? So basically this is a continuously journey is going on basically on giving the material basically on the credit. So credit may also be granted by a money lender, banker, or a financial institution. Clear? So here basically what is the meaning of the credit? Credit basically may be also granted by a money lender, banker, or low financial, and that is basically in the form of the loan. Clear? Basically they will provide you the money. Clear? So credit is generally provided. Clear? So how credit? Basically credit is generally provided by obtaining a written document called as instrument of credit. Clear? So basically how the credit basically will be generally provided. So credit is generally provided basically by obtaining a written document called as the instrument of credit, and this serves, clear, as a proof of existence of credit. Clear? Further basically this serves as a proof of existence of credit, and the most commonly used instrument of credit are bill of exchange and promissory note. Clear? And the most commonly used, clear, and the most commonly used basically instruments of credit are the bill of exchange and the promissory note. Clear? Are the bill of exchange and the promissory note. Clear? And definitely you will get basically one question from that. So please listen very carefully in the next 3 to 4 slides, and from that you will get definitely one question. So now let's discuss regarding that. Clear? So now let's discuss regarding that. First of all, basically, what is bill of exchange? Clear? What is bill of exchange? So bill of exchange, basically, it is defined as instrument in writing. Clear? First of all, basically, it is not verbally or oral. It is basically an instrument in writing. So basically, who will sign? It is signed by the maker. Clear? It is signed by the maker. Clear? That is basically who is signed. Basically, it is signed by the maker. Containing an unconditional order. Clear? So basically in the bill of exchange, basically there is an unconditional order. Clear? So bill of exchange, basically it is defined as instrument in writing signed by the maker. Clear? Basically, it is an instrument in writing, basically signed by the maker, containing an unconditional order. Clear? Basically, that is containing an unconditional order. Basically, what is mentioned? Clear? Containing an unconditional order. And under that, basically, what they have mentioned, to pay a certain sum of money and money only. Clear? To pay a certain sum of money and money only. Clear? To whom? That is basically to a person named in the instrument. Clear? Basically, either they have named specifically, that is basically you have to pay, and or to his order to the bearer. Clear? Or to his order to the bearer, like in the check. Clear? To a person basically named in the instrument, or to his order to the bearer on a certain fixed future date. Clear? Basically, on a certain fixed future date, or on demand. Clear? On a certain fixed future date or on demand. That is section 5 of the Negotiable Instrument Act. Clear? Or on demand. That is basically section 5 of the Negotiable Instrument Act. Clear? From the above definition, basically you will observe that there are three parties to a bill of exchange. Clear? So first one, basically, that is who is making the bill. Clear? Or who is signing the bill. Clear? And to whom name is mentioned. Clear? That is basically who will give the, to whom basically we have to give the payment. Clear? And payment is to be given by whom. Clear? Payment is to be given by whom. Clear? So bill of exchange, basically it is defined an instrument in writing signed by the maker, containing an unconditional order to pay a certain sum of money and money only to a person named in the instrument. Clear? Basically whom we have to pay the money, that is basically whose name is the instrument, or to his order to the bearer. And they are specifically also mentioned basically when they have to pay, that is basically on a certain future date. Clear? Basically either they have mentioned the date basically on specific that they have to pay, or on the other side basically or on demand. Clear? Basically or on demand. Clear? So these are the some basic things basically which you have to remember. Clear? And further basically or on demand and all these things basically, that is section 5 of the Negotiable Instrument Act. Clear? Section 5 of the Negotiable Instrument Act. Clear? This is mentioned under that. Clear? So Negotiable Instrument Act, basically it is 1881. Clear? It is 1881. So now let's discuss further. So basically here the question basically which they will ask in the exam, right? There are three persons basically in the bill of exchange: drawer, drawee, and pay. Clear? Drawer, drawee, and pay. Clear? So here drawer and pay, basically it is the same person. Clear? That is bill is to be maken by the drawer, that is basically who is going to receive the money. Clear? That is who is going to receive the money. Clear? And drawee, basically it is that person basically who is going to give the money. Clear? Basically who is going to give the money. Clear? So basically drawer, basically a person who draws the bill. Clear? Drawer, basically it is whom basically who draws the bill. Drawee, basically a person on whom the bill is drawn. Clear? Drawee, basically a person on whom the bill is drawn, that is basically you have to give the money. Clear? Drawee, basically that is a person on whom the bill is drawn, that is basically you have to give the money on a certain fixed future date. Clear? Third one is the pay. Clear? Third one is the pay, that is basically a person who is going to receive the money. Clear? Pay, basically who that a person who is going to receive the money. Clear? So generally basically like you are going to the shop. Clear? Basically for any purchasing any material. Clear? So the basically the shopkeeper owner makes a bill. Clear? The shopkeeper owner basically makes a bill and you have to give the payment. Clear? Or you will write that basically like basically you are working in the banks. Clear? So basically you will take the bill from the shopkeeper. That basically we will do the payment basically from the bank basically online to your account. Clear? To your account. Clear? So basically like we can say that basically we will do payment after 1 week. Clear? After 1 week. Just you have to return that basically after 1 week basically you will get the payment. Clear? So that is here the shopkeeper basically it is also called as a drawer because he is drawing the bill, and also it is also known as the pay. Clear? Because the shopkeeper basically will get the payment. Clear? The shopkeeper basically will get the payment. Clear? After the specific period. Clear? After the specific period, or the shopkeeper say that basically after 2 days basically you have to give the payment. Clear? So as per the guidelines. Clear? Or as per the drawer instructions. Clear? Basically we have to do that. Clear? We have to do that. So please tell fast now. Basically, it is clear to all of you basically what is bill of exchange. Please tell fast now. It is clear to all of you basically what is bill of exchange. Clear? And what are the different questions basically you will expect from that. Please tell fast. Okay, now move to the next one, that is promissory note. Clear? So there is a little difference. Clear? First of all, basically we will discuss one example on the basis of bill of exchange. So many a times, clear, basically many a times the drawer and the pay may be the same person. Clear? Many of the time, basically, I have already discussed with you that basically the drawer and the pay basically may be the same person. Clear? The drawer and the pay basically may be the same person. Clear? So let us suppose A sells goods to the B. Clear? Let us suppose basically A sells goods to the B basically on credit for rupees 10,000. Clear? That is basically we can say that not taking the payment. So A draws a bill on B and B accepts the same. So in the above case, basically A the seller. Clear? Basically A is the seller and also A is the creditor. Like basically in the case of the loan, bank is the creditor because bank is funding. Here A is funding, so A is the creditor and B is the debtor. So A, the seller, basically draws a bill on B, the purchaser or debtor, and it is payable to A. Clear? And it is payable to A. Clear? So thus, A is the drawer of the bill. Clear? A is the drawer of the bill and also the pay. Hence, it can be seen that a creditor basically draws a bill on a debtor. So let us see the actual format of a bill of exchange basically from the following particulars. Just if you are able to understand up to this much point, you are able to answer the question in the examination, or you are able to score 1 or 0.5 marks. Clear? 1 or 0.5 marks. Clear? Definitely you will basically find question from that. Clear? Definitely basically you will find question from that. Clear? So drawer, Mr. Suresh, 20 DN Road, Mumbai. Drawing Mr. Mehta 10 Shukrvar Peth Pune. Clear? That is Mr. Mehta has to pay rupees 10,000 to Mr. Suresh. Clear? That is amount is 10,000 and date of bill is basically 10 March 2019 and the date of acceptance basically that is 15th of March 2019. Clear? And basically within 2 months. Clear? Basically within the period of 2 months you have to pay. Clear? Basically you have to pay to the Mr. Suresh. Amount is rupees 10,000. Amount is rupees 10,000. Clear? So basically what is the actual format? That is there is a stamp G20 DN Road, Mumbai. Clear? That is basically it is to be written down by the Suresh. Clear? That is by the Suresh. 2 months after date, pay me or my order a sum of rupees 10,000 basically for the value received. Clear? 10,000 for the value received. Clear? So basically they have written that to the basically rupees 10,000 to Mr. Mehta, 121 Shukarpath Peth, Pune. Clear? This is the and here basically they have accepted. Clear? Basically they have accepted that Mr. Mehta basically has accepted that on 15th of March. Clear? That is basically when they will receive that. They have accepted that basically I have to pay. Clear? Basically after 2 months. Clear? So here basically sign of both will be received. Clear? So here basically sign of both will be taken. Here sign of the signature. Here sign of the Mr. Mehta. Clear? So basically this is the format of the bill of exchange. Okay, so now basically we have to next one, that is basically we have to discuss what is promissory note. What is P note or promissory note? Clear? So there is a little difference. And the question basically most probably basically they will ask basically from both of the that. Clear? What is promissory note and what is bill of exchange? Clear? Most of the time basically you will get question basically from these things. And these topics are very, very important for the upcoming other examinations also. Clear? Like basically after basically the LRAB, basically you will also find basically what is bill of exchange and what is promissory note in the PPB also. Basically you will find these terminologies. Clear? So now basically we have to move to next one, that is promissory note. Clear? So promissory note, and try to understand very carefully. Clear? There are some basic differences between both these things. Clear? So like we can say that basically the bill of exchange. Clear? I will tell you here side by side. Bill of exchange basically it is the maker of bill of exchange basically it is that person who is going to take money. Clear? Basically who is going to take money. Clear? But the promissory note, it is to be the maker of promissory note basically it is that person who is going to giving the money. Clear? Who is going to giving the money. Clear? So basically it is a written undertaking by the buyer. Make a payment on a specified date. Clear? Basically a written undertaking basically by the buyer to make a payment on a specified date. Clear? Can take the form of a bill of exchange or promissory note. Clear? So basically what is promissory note? Basically it is a written undertaking. It is basically a written undertaking basically by the buyer to make a payment, clear, to make a payment on a specified date, clear, basically to make a payment on a specified date, can take the form of the bill, clear, basically can take the form of the bill of exchange or a promissory note, clear. So we have seen earlier that a bill of exchange basically it is drawn by the creditor and accepted by the debtor, clear. On the other side, a promissory note basically on the other side, it is written by the debtor, that is the buyer, promising the creditor, clear, that is promising the credit, that is basically I have to give you the payment, clear, to pay a specified sum, clear, to basically pay a specified sum after a specified period, clear, to pay a specified sum basically after a specified period, clear. So thus it can be defined as, clear, so how it can be defined, so thus it can be defined as basically an instrument in writing. This one is to containing an unconditional undertaking signed by the maker to pay a certain sum of money, clear, signed by the maker to pay a certain sum of money, clear, that is basically here signed by the maker, basically unconditional order, basically here it is drawn by the drawer, that is basically you have to give, and here basically signed by the maker, that is I have to give, clear. It is an containing an unconditional undertaking basically signed by the maker to pay a certain sum of money, clear, to basically pay a certain sum of money to or to the order of a certain person or to the bearer of the instrument, clear, or to the bearer of the instrument, clear. Further, basically that is basically promissory note, that is section 4 of the Negotiable Instrument Act, and bill of exchange, section 5 of the Negotiable Instrument Act, clear, of the Negotiable Instrument Act, clear. So in the case of the promissory notes, clear, basically in the case of the promissory notes, basically there are only two parties, clear, basically in the case of the promissory notes, basically there are only two parties, clear. First one is the maker, second one is the pay, clear. Basically in the case of the promissory notes, basically there are only two parties. First one is the maker and second one is the pay, clear. Maker basically who is that? A person basically who makes the notes and promises to make the payment, clear, promises to make the payment, clear. Pay, that is basically the person who is going to receive the money, clear. So please remember that basically the next important difference, clear, basically in the bill of exchange, basically three parties are involved, clear, basically in the bill of exchange, three parties are involved. On the other side, clear, basically in the promissory note, basically only two parties are involved. Clear, so all the important points, please remember that, clear. So please remember all these important differences regarding that, clear. Please remember these things, clear, that are very, very important basically for the examination point of view, clear. So please remember all these things, clear. Basically what is promissory note and what is bill of exchange. Now let's discuss one example here, same thing. So using the same data given in the earlier form of bill of exchange, promissory note basically will appear as under stamp. So it is basically that this is the name of the basically drawer or maker. In the previous case, basically it is drawn by the Mr. Suresh, basically who is going to receive the money, and here basically because that is drawn by that, clear, here it is drawn by the Mr. Mehta. So this address, and 2 months after that, here they're saying that basically I promise to pay, clear, basically I promise to pay Mr. Suresh or his order a sum of rupees 10,000 only, basically for the value saved, clear, for the value saved. They have designated that to Mr. Suresh 110 DN Mumbai. This is the sign of, here basically there is sign of the Mr. Mehta. Okay, so this is the main difference, clear. So basically this is the main difference between the promissory note and the bill of exchange, clear. Basically this is the main difference between the promissory note and the bill of exchange, clear. Hope it is clear to all of you basically up to this much point, like what is the basic difference between the promissory note and the bill of exchange. Please tell fast if you have doubt, any query even after that. It is clear to all of you, like basically what is the basic difference between the promissory note and the bill of exchange. Now move to the next one, that is basically what is the difference between that, clear, what is the difference between that, clear. So basically distinction between a bill of exchange and a promissory note, clear. Bill of exchange, here it is promissory note. So basically it is an unconditional order to pay, clear. Basically it is an unconditional order to pay, that is basically it is drawn by the drawer. That is basically the drawer is basically ordering to pay, clear, and it is an unconditional promise to pay. Promissory note, that I am doing promise with you that I will pay this much amount to you. Clear? Basically, I will pay basically this much amount to you basically on a specific date. Clear? This much amount to you basically on a specific date. Clear? So this is the thing basically which you have to remember that. Clear? Bill of exchange basically it is an unconditional order to pay, and promissory note basically it is an unconditional promise to pay. Clear? Basically it is an unconditional promise to pay. Clear? This one is the first. It is made by the creditor. Clear? It is made by the creditor. It is made by the debtor. Clear? It is made by the debtor. And in the case of the bill of exchange, clear, basically acceptance by the debtor is necessary. Clear? That's why basically we have mentioned the signature of the debtor on that. Clear? Basically that's why basically we have mentioned the signature of the debtor on that. Clear? So acceptance by the debtor is a necessary. Clear? In the case of the bill of exchange. Clear? And in the case of the promissory note. Clear? And in the case of the promissory note, basically no acceptance is required. Clear? And in the case of the promissory note, basically no acceptance is to be required. Clear? And next one, basically, there are three parties to a bill of exchange. That is basically drawer, drawee, pay. On the other side, basically, there are only two parties to a promissory note. Clear? On the other side, basically, there are only two parties to a promissory note. Clear? So this one is the main difference, which you have to remember that. Clear? There are only two parties basically to the promissory note. Clear? Next one is on dishonor of a bill. Clear? Basically on dishonor of a bill, it is usually noted by the notary public. Clear? Basically on dishonor of a bill, that is basically when they will not get the payment. Clear? So on dishonor of a bill, it is usually noted by the notary public. Clear? So noting is not necessary. Clear? In the case of the promissory note, basically noting is not necessary because already the person basically who is going to give the money, they are already promising that I will give the money on the specific date. Clear? I will give the money on the specific date. Clear? So here noting is not necessary. Clear? So for a person, drawer, who is going to receive the money, clear, basically who is going to receive the money against the bill, clear, that said bill basically will be bills receivable, clear, basically will be bills receivable, clear. The person basically who is going to receive the money, clear, the person basically who is going to receive the money against the said bill, clear, basically against the said bill, that person basically it is known to be as that person basically it is known to be, or that bill, it is known to be as the bill receivable. Clear? That bill basically it is known to be as the bill receivable. And whereas basically for the person who has to pay against this bill, clear, and who has to pay basically against this bill, that is the drawee. Clear? That is the drawee or the pay maker. That who has to pay against this bill, basically it is called as the bills payable. Clear? It is called as the bills payable. Clear? And further, this is one more 0.5 mark question. Clear? Basically this is one more 0.5 mark question. So what is bills receivable or bill receivable? That is basically you are getting a payment from that. Clear? Basically with the help of that, basically you are going to receive the money. So bills receivable basically it is treated as the asset. Clear? Basically bills receivable basically it is treated as the asset because with the bills receivable, you are going to get the money. Clear? Basically you are going to get the money. Clear? On the other side, basically what is the meaning of bills payable? Bills payable, that is basically this is the liability. Clear? This is the liability. Clear? Very, very important. Bills receivable, basically it is the asset. Bills payable, it is the liability. Clear? Please tell fast if you have any doubt up to this much point. Clear? Bills payable, basically it is the liability. That is basically this much amount basically you have to pay. Clear? So for accounting purpose, basically there is no distinction is made basically between the bills of exchange and promissory note, but for accounting purpose, clear. But in the general purpose, clear, bills payable, that is basically it is considered to be as asset, and bills payable, sorry, bills receivable, basically it is considered as asset. Clear? And bills payable, that is basically it is considered to be as the liability. Clear? It is considered to be as the liability. Any other doubt, any other query basically up to this much point? Please tell fast if you have any other doubt, any other query up to this much point. Clear? Because there are some other points left with respect to this session, along with the questions which we have to cover in the next session. Last point basically I will cover with you, like with respect to the check. Clear? So according to section 6, clear, we have discussed section 4. Section 4 is, this is basically section 4. This is section 5. And section 6 is basically check. Clear? So according to section 6 of the Negotiable Instrument Act, a check, it is a bill of exchange drawn upon a specified banker and payable on demand. Clear? So basically a check on whom it is to be drawn, basically on a specified banker. Clear? So here the drawing, basically it is the banker. Clear? That a banker is giving to the banker is going to give the money basically on the behalf of the customer. Clear? On the behalf of the customer. Clear? So according to section 6 of the Negotiable Instrument Act, basically a check, it is a bill of exchange drawn upon a specified banker and payable on demand. Clear? Drawn on a specified banker and payable on demand. Clear? So now let's discuss some of the important features regarding the check. So a check has the following features. A check must fulfill all the essential elements of a bill of exchange. It must be payable to the bearer or to the order. But in either case, basically, it must be payable on demand. Clear? So it must be payable to the bearer or to the order. But in either case, clear, basically, but in either case, it must be payable on demand. Clear? But in either case, it must be payable on demand. Clear? Next one is the banker named therein pays it basically when it is presented for payment. Clear? So the banker name therein basically pays it. Clear? Basically when it is present. Clear? So basically it is payable on demand. Clear? So basically it is payable on demand. Clear? Next one is the signature basically must tally with the specimen signature of the drawer basically kept in the bank. Clear? Basically the person basically who is going to make that check. Clear? They have also give their signature. Basically I have also their account in that bank. Clear? And on that basically they are doing one specific signature. Clear? So that signature basically it is to match it with the signature basically drawn on the check. Clear? Basically drawn on the check. Clear? Next one is a check must be dated. Clear? A check must be dated. Clear? As per the present guidelines. Clear? Basically a check must to be represented basically like we can say that if the date is on 20 March 2020. Clear? So they have to represent that check basically within the next 90 days. Clear? Within the next 90 days. Clear? After that, basically, the check basically will become invalid. Clear? After that, basically, the check basically will become invalid. Clear? So a check drawn basically with the future date is valid, but the same is payable on and after such specified period. Clear? Like basically, we can say that if today is 24th March and the check has basically date 29 March. Clear? So that check is also valid. Clear? 29 March. That check is also valid. Clear? Basically, but only after 29th March. Clear? Or on and after 29th March. Clear? That check is also valid, but only after or on that specific date. Clear? So a check drawn basically must have future date basically it is valid, but the same is payable basically on or after such a specified period. Clear? But the same is to be payable basically on or after such specified period. Clear? So these are some of the essential features of the check. So in the next session, basically we have to difference between what is the difference between the check and the bill of exchange and some other important terminologies basically regarding the bill of exchange. Clear? So very, very important topic and very easy topic. Clear? If you understand this topic properly, so you will definitely able to score basically 1.5 or 2 marks. Clear? We will expect that at least 1.5 or 2 mark question basically they will ask from the chapter, this chapter, and that are easily scoring topic. Clear? Very easy scoring topic. Clear? And this also help you to basically score marks in the legal and PPB also. Clear? Sometimes basically they will ask question on the basis of these things at that place also. Clear? So thanks to all of you for joining this session. Hope all of you are able to understand all these important terminologies.